AI does not eliminate labor, it reprices it. And the difference between substitution and augmentation determines who captures the margin. The central economic question is not whether artificial intelligence replaces workers. It is whether it removes labor cost from the income statement or amplifies labor output within it. Substitution reduces headcount. Augmentation increases throughput. Both alter cost structures, but they do so through different financial plumbing, and the balance sheet consequences diverge immediately. Labor substitution occurs when AI performs tasks previously executed by employees, reducing variable labor expense. Payroll declines, marginal cost compresses, the break-even point shifts downward. In pure substitution, the objective is cost elimination. The savings appear measurable and immediate. But substitution also removes embedded institutional knowledge, narrows redundancy buffers, and introduces new infrastructure exposure. What looks like salary savings often reappears as integration cost, vendor dependency, and system maintenance overhead. There is also a shadow operating expense that emerges after the layoffs. Substitution assumes a static environment, but markets are fluid, models drift, data distributions shift, regulations evolve, customer behavior mutates. When you remove a human, you remove a sensor capable of real-time contextual adaptation. Replacing that sensor requires an additional layer of validation labor. Firms now employ model drift monitors, prompt engineers, performance auditors, and exception validators to ensure automated outputs remain economically safe. You are not eliminating labor. You are migrating it from the operations bucket to the quality assurance bucket. In 2026, many firms that reduced junior staff are now hiring model auditors at double the compensation. The variable cost they believe they eliminated returns in a new form. It is the revenge of the variable cost. Augmentation operates differently. It keeps the worker and multiplies their output. An analyst processes 5 times the volume. A legal associate drafts in hours what required days. A sales team scales outreach algorithmically. Headcount remains stable, but revenue per employee increases. Augmentation does not reduce cost per employee. It reduces cost per unit of output. The financial lever shifts from expense compression to operating leverage expansion. The distinction becomes visible in contribution margin. Under substitution, gross margin improves because direct labor costs fall. Under augmentation, gross margin improves because revenue expands faster than payroll. The former is defensive, the latter is expansive, but augmentation carries diffusion risk. When productivity tools standardize across an industry, price competition intensifies. What begins as augmentation can end as commoditization. And when every firm in a sector adopts the same augmentation stack, the margin does not accrue to the operator, it migrates upstream to the model provider. Law firms using the same litigation. AI suite produce similar output. Marketing agencies using identical generative systems converge towards standardized campaigns. Differentiation narrows. Pricing power erodes. This is the oligopoly tax. Firms trade proprietary human judgment for rented algorithmic intelligence. There is a second-order effect. Substitution is a form of asset liquidation. When firms remove junior and middle layers of labor, they stop training the next generation of operators. Human capital compounds through repetition, failure, and apprenticeship. AI substitution interrupts that compounding process. The firm experiences a short-term margin spike, but it simultaneously erodes its institutional alpha. 5 years later, there is no deeply trained middle layer capable of strategic nuance. The leadership pipeline thins. The organization becomes dependent on external intelligence providers for insight it once developed internally. This is intellectual asset depreciation. Companies harvest their human capital for quarterly beta improvements while quietly weakening their long-term alpha engine. There is also a timing asymmetry. Substitution produces immediate payroll visibility. Augmentation requires demand elasticity. If increased productivity does not meet expandable demand, surplus capacity emerges. Productivity first, layoffs later. The income statement adjusts with delay. From a capital allocation perspective, substitution reduces operating expense but increases fixed exposure. Technology enters the capital column. The company trades wage flexibility for infrastructure rigidity. This is where the real math begins. In 2026, CFOs track inference per dollar and token-to-wage parity. Every automated task is evaluated against a compute threshold. If the electricity, GPU depreciation, and cloud overhead of generating a report exceed a defined percentage of the equivalent human wage, substitution becomes negative carry. Unlike wages, which are contractually stable, compute pricing fluctuates with energy markets and hardware supply constraints. This introduces variable cost volatility into what was previously predictable payroll. Firms are now calculating the embedded compute tax of each automated decision. Substitution only holds if compute remains structurally cheaper than cognition. That arbitrage moves with infrastructure cycles. Augmentation preserves workforce flexibility but embeds dependency. Labor remains, but productivity coefficients rise. Revenue per employee increases. However, as augmentation spreads across competitors, pricing compresses. Productivity gains diffuse into lower prices. Industry margins normalize. The long-term winner becomes the infrastructure layer supplying intelligence at scale. At the macro level, substitution reduces labor demand in quantity. Augmentation redistributes it by skill intensity. Routine roles compress. Oversight, integration, and exception management expand. The labor market does not disappear. It stratifies. This stratification creates an internal economic tax. As routine work collapses into automation, the remaining human layer concentrates around failure management. AI handles the majority of tasks cheaply. The residual edge cases, model breakdowns, reputational exposures, strategic anomalies, require elite labor. Substitution saves on the floor. Augmentation inflates the ceiling. Organizations no longer employ 100 clerks. They retain 5 crisis managers at multiples of previous salaries. When automated systems fail, they fail at scale. A single error propagates across thousands of outputs. Savings from junior labor are partially absorbed by retention premiums, insurance buffers, and fragility reserves. This is the fragility premium embedded in automated firms. The strategic error is assuming substitution and augmentation are interchangeable. They are not. Substitution optimizes cost efficiency. Augmentation optimizes output density. Substitution reduces payroll lines. Augmentation increases revenue per payroll line. The metrics differ. The risk exposures differ. The capital rigidity differs. Ultimately, the economic question converges on output leverage per human node. How many dollars of revenue does each remaining worker control? In capital markets, that ratio determines valuation. Public markets now track AI to labor ratios as a proxy for scalability. Firms that substitute labor are rewarded with technology multiples. Firms that merely augment are often priced as service entities. This creates valuation arbitrage. A CEO can raise the stock's multiple by reducing headcount, even if augmentation would produce stronger long-term cash flow. In extreme cases, firms pursue substitution not for efficiency, but for re-rating. But the market narrative is beginning to bifurcate. High-yield capital is starting to question over-substituted firms. If a company's entire margin depends on a single API pricing schedule or cloud provider, it resembles a hardware bet more than a resilient cash flow moat. It becomes derivative to infrastructure it does not control. Investors are beginning to differentiate between firms that use AI to eliminate labor and firms that use AI to increase the strategic complexity of their human nodes. The former may scale quickly, the latter may endure longer. The inference to dividend pipeline is now part of equity analysis. Over-substitution reduces payroll, but it can also reduce adaptive resilience. Markets are slowly pricing that risk. AI does not end labor. It reallocates its leverage. Substitution compresses cost. Augmentation accelerates output. But long-term economic advantage belongs to the firm that understands where labor is removed, where it is amplified, and where it must remain strategically irreplaceable.